We've got with us Jerome Booth, Head of Research at Ashmore Investment Management. He joins us on the show. Jerome, hi. Firstly, what is your approach to India, given the macro risks that we're currently dealing with, and of course the central bank keeping its focus on inflation at this juncture?
Well, I think the RBI has, is very sensibly waiting to see initiatives from the government on reform, so as to, if you like, get in front of the curve. And we need to see investment come back, and then and growth, and then I think the RBI will cut rates. And I think that's important to preserve credibility. So that's, I think, as predicted. The important issue, of course, is therefore what is the government going to be doing with the blackouts? It should be impossible now for anybody to deny that there needs to be some major investment and some major reforms in that sector, and in fact in other sectors. Crises are also opportunities. They provide politicians the chances to make bold moves. It still requires leadership, and that's what we have to see. But there is now an opportunity through this terrible electricity sector problem to actually re-engage and have a much more positive dynamic in terms of real reforms, and importantly set the stage for major increases in infrastructure investment.
Right. So the big question for India is that what will happen to the growth, and especially GDP growth? What is your assessment? Do you think for FY13 we could have a print of sub 6%?
Well, I think more importantly is what the longer-term sustainable growth rate is, and that's why I'm so focused on infrastructure. And I think in the short term it does depend on the government taking some bold moves. That in turn invigorating investment spend by the private sector. That could then lead to more accommodative monetary policy as the RBI follows, and that could all come into play certainly within the next year, and we could be back at a sort of 6% or even higher trajectory of growth. But it's no point sort of going all out for that if you haven't got those conditions right. If it's just going to lead to inflation, if you don't have the confidence in the private sector, you don't have investment-led growth. So it is important to do the groundwork, and where the economy is next year will depend, I think, on government actions today.
Jerome, so I mean, would you buy Indian equities right now, and if so, what sectors would you pick up?
I didn't say I would necessarily buy infrastructure, but I think it's very, very important. I think there are opportunities, particularly at the sort of smaller cap level. There are a lot of company-specific opportunities right now, and we do have obviously cheaper levels. We have had, certainly prospective PEs really come off quite a bit. So there's quite a lot of value now, and I think oil prices or energy prices in general have come off slightly. India's actually looking much better value than it was a month ago.
Jerome, at a time when global growth scare is still there, US is in some kind of a recession. It could be depression soon. US economic data of late has been mixed. Emerging markets are the only place to invest in. Emerging market equities are expensive, and do you think emerging market debt could give some kind of an opportunity?
I'm intrigued by your saying that emerging debt has limited opportunities. I mean, this is $12 trillion out of a total fixed income market globally of $80 trillion, and most people are massively underweight. So I think that's completely wrong. I mean, if you look at only the bit that a lot of people look at, fine, you can make that argument. Perhaps I don't agree with it, but the point is that these are some of the largest or fastest growing markets in the world, and spreads are compelling. Even on the the relatively small sovereign dollar-denominated debt, the spreads are sort of 320 or so, 330, and that compares to 170 before Lehman's blew up in 2008, and so they're still extraordinarily cheap. There's also just a huge variety of asset classes in emerging markets. One can do money markets. A $9 trillion market, basically, cash only in currencies likely to appreciate over the medium term, as opposed to go down like the currencies in the developed world. and you have local currency sovereign bonds, you have corporate bonds, as well as equity, as well as real assets. There's a lot to do, and most people are massively underweight. So I think one of the main features of what's going on in Europe and of course in the US is the problems are not going away. We have periods when things sort of go up and down, people are more optimistic, less optimistic, and we can talk about that. But one of the things that happens is that people's perception of risk is gradually changing, and they're realizing that there is no such thing as risk-free. And they better not just ignore 85% of the world's population, 50% of the economic activity on the planet, to say that it's somehow marginal or something that you think of as an afterthought is fundamentally wrong. And these are the relatively safe parts of the investment universe as well. We just have a very distorted view of asset class geography, and people need to look at a map, frankly.